We need to talk about Ecomi's burn system. On the initial release, it was a real wildcard with the token valuation, a burning mechanism tied to the sale of their digital collectibles from the most recognizable brands in the world. They have the most diverse offerings of digital collectibles out there. When the company projects $1 billion in revenue, it was a no-brainer. I did the calculations, the amount of burns were going to be tremendous. Last year, I released a video with a detailed model on the OMI token. What people didn't see was in the back end. I saw what the burns would do. In fact, there was a scenario with a broader crypto market crash combined with the app continuing to generate revenue. I made a secret message that would pop up when someone input those variables, and I called it the cheat code. The thing is, there were two parts to the OMI burns. The burn from non-circulating supply, and then the buyback, which does affect circulating supply. But to ensure that the company doesn't get hit hard with regulatory issues, to avoid being classified as security, the buybacks have been halted. That burn system is now broken. And while they're technically not off the table, I'm certain we won't be seeing any buybacks, at least not in the form that they were originally. While that is disappointing, I understand it, and I'm okay with it. It's a decision that eliminates a going concern issue, and those always need to be addressed first and foremost. So today, we have a whole new landscape of OMI burns. I've done some calculations to see where we could go with each of those new different sources of burns. And of course, for each of them, I'll give you my thoughts, my analysis, and future outlook. Let's get into it. I've split up the new burn sources into three categories: third-party burns, OUP, and burns related to Veveverse land. And just a heads up, there will be a lot of calculations. I'll go as quickly as I can through it, but I believe it's important I let you know how I derived all these numbers. Now let's start off with what I call third-party burns. Firstly, we have the fishies. These are animated NFT fish, and they have a play-to-earn aspect with their fish arena. Regarding burns, 50% of all ranked matches will be burned, 50% of OMI collected from waged matches will be burned, and 50% of all fun points sold will also be burned. All burns are sent to the L2 or Layer 2 OMI Reserve wallet, which is out of circulation, which is then to be permanently burnt by the sale of Veve NFTs. Now, how much will be burned from this? Well, I'm going to get there in a second, but let's first look at that next third-party burn, Ecomi Regal. This is a tower defense game played on mobile that also utilizes the OMI token. Regarding burns, 10% of all OMI collected on the Ecomi Regal marketplace will also be returned to the OMI reserved wallet each quarter to be burnt by the sale of Veve digital collectible NFTs. Both of these games burn OMI by moving tokens to the OMI reserved wallet. So let's do a little blockchain sleuthing here. Here's a Mutascan and the OMI reserved wallet. I've exported the last 3 months into Excel, and you can see there are only 2 addresses who actually are depositing OMI into this OMI reserve wallet. There should be zero reason for anybody to be depositing tokens to this wallet. They should all be outflows. These 2 wallets therefore have to be the burns from Fishies and Ecomi. Now, it doesn't matter which wallet is whose, you'll see why in a second. When we add up the last 3 months of actuals for both wallets, we get 313,000 OMI tokens. Prorated for a full year, that's 1.25 million tokens, and just over 6 million tokens over 5 years, all at the current level of activity for both platforms. When the circulating supply of OMI is about 300 billion tokens, 6 million tokens is a drop in the bucket, in that very, very large bucket. At first glance, it's not going to take us to the moon, but there is a very, very important positive that I'll get to in a second after we cover Collective Shift. Collective Shift is a digital asset research and education platform. So basically it's crypto school. 30% of their membership fee is put towards market buying OMI to be burned from their circulating supply. Collective Shift reportedly has about 3,000 members with 3 tiers in their membership, the most expensive being $169 per month. So let's say 50% of those customers use this special link required to initiate the Learn to Burn initiative. I'd say 50% is aggressive, but in the big picture, it really doesn't matter. We get a monthly OMI burn of about 51 million tokens and 608 million tokens over the course of a year. It would take 5 years to burn 1% of the circulating supply at that rate. So overall, this category that I've called third-party burns is not a quick replacement to that broken cheat code. With its current level of activity, the numbers prove that. The silver lining is if the platform can continue to develop with gamification and Veveverse and all the traditional marketing everyone is clamoring for, more companies will then want to associate themselves with what would be a burgeoning user base. You can bet that there will be more sources of burns from this category as companies want to partner with an NFT and metaverse leader in Ecomi. Let's look at now OUP or OMI utility program and the burns from there. There will be token burns based on your OMI staking tier. None for tier 1, but there is a 0.5% burn for tier 2 and a 0.25% burn for tier 3. These are on P2P sales, or in other words, sales on the secondary market, where the buyer pays this fee. Now, in order to get some projections, I'm going to start with the burn spreadsheet from Puddin Cheeks. So special thanks to Puddin for continuing to update this for the community. We need to get the activity on the secondary market, so I've highlighted in blue the drop days for the last 6 weeks or so. The non-highlighted rows are then non-drop days. Again, burns will only be on P2P sales, aka the secondary market. So to get that, I've input here the sales proceeds from the primary market. Remember, these are burned at 100%, so we will just do some simple subtraction to get the dollar value of the secondary market burns. We can estimate the amount of dollars exchanged on the secondary market since those burns are 2.5%. We just divide these amounts by 2.5% and then get the average. This results in about $2.5 million on average exchanged on the secondary market on a daily basis. Over the course of a year, that's $935 million. Now we need to break it down by what tier we can possibly expect them to come from. One survey showed only 5 to 20% of game communities take part in the pay-to-win approach, aka spend money on the game. This gives us a great place to start. For now, let's use that 20% participation rate as well, and that would be tiers 1 to 3 of the OUP, and the remaining 80% can be the people who decide not to participate in OUP. The remaining percentages, I chose 10%, 7%, and 3% for now, but we will try out other scenarios to show the difference. Since only tiers 2 and 3 burn tokens at 0.5% and 0.25%, this becomes an easy calculation. OUP will burn 264 million OMI tokens, or 0.1% of the circulating supply, at the current year's activity levels. This doesn't sound like a lot, but like I said, this is the current activity levels. This is a bear market, ladies and gentlemen. Activity on OpenSea, Decentraland, Sandbox, and Axie Infinity are down quite a bit. So let's take these numbers and compare them to our favorite goalpost again, Pokemon Go, and let's run some numbers. I think Reese did say in his last interview that we had around 1 million daily active users. So if we have the amount burned with 1 million active users, it's just a simple multiplication using the Pokemon Go user data to get how much will be burned if we follow the same trajectory as Pokemon Go. This is assuming that we have a direct and proportional relationship to secondary market activity as daily active users. Adding that up, hey, that's not too bad at all. 67% of the circulating supply can be burned over 6 years following the same trajectory as Pokemon Go. There are a few things to note. These values change quite a bit as the tier breakdown changes. If we change this to 95, 2, 2, and 1%, for example, the burn changes to 20% over that same period and trajectory. We also need to look at a conservative approach. If Veve can operate with the activity of the worst performing year of Pokemon Go, then we would burn 1.85% per year, and that's 9% over 5 years. Now, while that's not a ton of burns, it's a good amount, but the potential is there to burn significantly more. Also, keep in mind how many other deflationary tokens are out there with this kind of potential, with this kind of product offering. There's only a few, and Ecomi is one of them. I'm okay with only a 0.5% and a 0.25% burn rate, because if you put too many fees on both the seller and the buyer, you can stagnate the economy, you can stagnate economic activity. With these numbers, it's fine. A $100 purchase will only cost an additional 50 cents. So the key isn't charging customers more to burn, it's having enough incentive in this OUP to ensure we get enough people to the burning tiers 2 and 3. And of course, it's important to keep building the platform. Also, here's the thing, as I stared at these numbers, it felt at times it was a little too aggressive in the sense that, man, Pokemon Go, it broke records. It is the number 5 of all time highest grossing mobile games out there. It might be hard to repeat. On the other hand, if we can get the Pokemon license plus gamification in combination with the licenses we already have, let's put it this way. If there's any NFT project out there that can replicate that success, I'm betting on Ecomi. Just to be clear though, we do not have Pokemon yet. I'm not saying we do, I'm not saying we will, but man, there are a lot of breadcrumbs. There are a few other burn sources from OUP. First is the raffle. It's probably not going to be a lot because only the winner of the raffle will have their OMI burned. And it was also mentioned by Reese about 9 months ago that in the future, these 2.5% secondary market fees will be burned directly from circulating supply if you purchase collectibles with OMI. I mean, it could be a lot. It could also be very little burns. Personally, I wouldn't transact with OMI as I think its greatest potential is capital gains. So that spread is too big, and I don't have any logic that I can draw on to see where we could land in that range. Just something to note, it's just another source of burns. So let's get into that final category, Veve versus land. To see where Ecomi can go, let's look at other metaverse land sales. Now, let's assume that land purchased with OMI is 100% burned. I do believe that was mentioned in the past and will be the case. Terra Virtua sold 12,999 plots of land for 10,000 ADA. And at today's price, that's proceeds of $732,105. If Ecomi has a similar sale to Virtua, then at my adjusted OMI price, that would burn 400 million tokens, or 0.2% of the circulating supply. I'll explain what my adjusted OMI price is in a second. Decentraland had proceeds of 25 million on the sale of 90,000 plots of land from 2 land auction sales, plus mana spent on creating their DAO was also burned. If Ecomi has something similar, then at my adjusted OMI price, we would burn about 17 billion tokens, or 6.1% of the circulating supply. Illuvium raised $72 million on their land sale from just under 20,000 plots of land. If Ecomi does something similar, then at my adjusted OMI price, we would burn just under 46 billion OMI tokens, or 16.5% of the circulating supply. And finally, Sandbox. They made a killing, selling a whopping 166,000 plots of land, currently valued at $1.27 billion. At my adjusted OMI price, that would burn all of the circulating supply. Now, my adjusted OMI price is not the current OMI price. I think most people would just take that current price and divide the proceeds from the sale, from the land sale by it. A more thorough and more accurate model understands that, let's take Sandbox for example. If there are proceeds of 1.27 billion tokens, that means sales of 1.27 billion tokens, are you telling me that that wouldn't move the price? Of course it will. Here's a great example. Here's Decentraland in the bear market of 2018 when they had their land sale. This is a good example because the rise here is not influenced by Bitcoin as it was flat over the same period. Now, Decentraland's market cap went from 50 million to 77 million during that land sale, in a bear market with the big caps not doing anything. This was because of the land sale, so I adjust the market cap and consequently the price with a factor of the additional proceeds from the sale of the land. With that explained, let's get back to the data. Now, obviously there is a large degree of deviation. If they go the Sandbox route, that's obviously the biggest one-time benefit for burns. And if I were to guess, they go at least the Decentraland route. Remember back in the early days, Decentraland was listed as a partner of Ecomi. It seems somewhere along the line, and this is pure speculation on my part, it seems the Ecomi team realized they have an opportunity, not just to be another vendor of someone else's metaverse. With the amount of brands and with Al Khan on board, they could end up being one of the leading metaverses themselves. We can see some similarities with their intent to burn tokens on land sales plus burns throughout their ecosystem. Decentraland also burns 2.5% of land sold on the secondary market and have small burns with other activities as well. It's the strategy of both companies of a death by 1,000 cuts, it seems, with some bigger hits here and there. A similar strategy, and maybe that's the takeaway from that earlier partnership. My recommendation to all this is I'd personally recommend using OMI for any land change or improvement. For example, make those land changes or improvements transacted only with OMI. For example, if I build a small bookshelf to hold my collection of comic book NFTs, that would cost me OMI and that all gets burned. If I then sell this land to, say, Sleep in Comics, a great content creator, collector, and fan of comics, definitely give him a follow. But let's say he builds a bigger bookshelf because he has a much bigger collection than I do. He probably has a bigger collection than most. Then the demolition of my bookshelf plus his new one would cost OMI, all of which gets burned. And let's say he flips that around to Randy Chavez, and Randy wants to build a pool for all his Loki Gators, and the same thing. All that is transacted in OMI, and all that gets burned. Just to conclude things, the burning mechanisms are much different today than they were last year. It's less about a big home run swing to more of a longer-term multi-vector attack. And these vectors can range from the death by 1,000 cuts approach to some heavier blows with OUP and land and related transactions. Cumulatively, this approach is exciting as an OMI investor. It's also an approach that only works with strong businesses that plan to stick around for a long time, which is exactly what Ecomi is. And what's even more bullish is that these sources of burns can only get bigger, and I expect more to come as OUP evolves, as gamification develops, and as Veve versus land starts to take place. So stay tuned as new information gets released. I'll give you my thoughts and analysis here at the Hodlor Fin. Thanks so much for watching. Please consider liking, subscribing, and following. And I'll see you in the next video.
Go twice as high. Take a look, it's in a book. The reading rainbow. I love you all. Give yourselves a hand. That was